Okay, awesome. We are live. Welcome to Sacred Account Saturday, everyone. It's good to see you all. Thanks for tuning in. My name is Jerry Fetta. I'm the owner, founder, and CEO of Wealth Dynamics. And I am excited today for Sacred Account Saturday, one of my favorite things about the weekend here. So before we get started, I want to make a couple of normal announcements. First one being, as we're going through this, we're going to be talking about finances, right? And finances are a topic that oftentimes I hear people say they're confusing. It's something that I could never learn. It's for the wealthy. It's a lot of different things we hear, right? And I want to grant some validity to that because Wall Street and banks do make finances confusing, right? Like who wouldn't be confused at some of the terminology and like just look at a portfolio for the stock market and tell me you're not confused when you're done. Right. So some of that is definitely true. But with all that being said, it comes down to two things: math and vocabulary. Okay. Do I understand the words being used? And if I don't, then I'm not going to understand the subject. In this case, it's finances. Now I'm going to let you in on a secret. Groups that want to keep others ignorant make the topic sound more confusing than it really is. This is how slavery is started, right? You make people feel like they can't know. They rely on another group, on another party, and then they're like, okay, fine, I'm going to give up all responsibility and just let the experts handle it. Well, sometimes the experts aren't so expert. Sometimes they don't have our best interest. Sometimes they're focusing on what they're focusing on, and that doesn't mean that we're going to win because of what they're doing. So it's important to understand, as I'm going through this today with this course, if there's anything I say that doesn't make sense, I want you to actually comment and be like, hey, can you explain this? What did that word mean? When you went over this concept, what did that mean? Can you make that more simple? If anything like that comes up, let me know right away. The second thing is we've got to also have the viewpoint that we don't know it all already. Okay. So unless you're already a top 1%er, unless you already have passive income that exceeds your savings, expenses, and taxes, unless you already have zero consumer debt, 6 months in reserves, you're properly protected, you're investing, you're doing all this great stuff, then there's still more to learn, right? And if there's more to learn, that means I don't know it all. And I can't learn it until I realize that I don't know it all and that there is more to learn, right? Like if I think I know it all, why would I learn something? Okay, now here's the thing about thinking I know it all. Every time I thought I know it all, it always bit me in the ass. Every single time without fail. Okay, and so I want to have the viewpoint of, okay, what can I learn? And then also the third thing is, what can I apply here? Okay, what's my purpose for being on this course? What am I trying to get out of it to take back into my life? Today's Saturday. Like I want to be using this stuff by tomorrow. I want to be putting some of these concepts into application by tomorrow. And speed of application for me is the evidence of understanding. I'm going to say that one again. Speed of application is the evidence of understanding. If I understand something, I can implement it right away and I can do it quickly, right? So those are some of the main points I want to cover. I will be going live as well throughout the course to answer questions. So if you're on Facebook, drop your questions in the comments. If you're on Zoom, drop your questions in the chat. And we're going to have a great course here today. And without further ado, I want to jump into our topic. So we're going to be talking about the sacred account. It is Sacred Account Saturday, so that makes sense, right? But I want to talk about like what this is. I'm going to give an intro to that because not everyone's familiar with what the sacred account is. I'm going to hit that pretty quick as well. And then I also want to get into, how it works with the wealthy. One more thing before I forget, there's two people on this webinar that are on my team. They work for me, Nano Aquino and Rod Torres. Okay, so Nano has been with me for almost 5 years now, over 4 years, working with clients, helping with sales, helping with service, just getting people through their blueprint and towards their financial goals. So if Nano reaches out to you, be sure to comment back. Okay, don't be that weirdo that sees his message and is like, I don't want to answer. This is weird. I'm going to pretend I never saw it. He's trying to help you out. He wants to get on a call and see if he can answer your questions. So if at any point you do have questions, you can reach out to Nano. The other person is Rodrigo Torres. Rod's also a staff member of mine. Rod's been with me about when did Rod start? It feels like forever. Rod has been with me since April. Rod has 22 years of experience with sales, marketing, recruiting, literally building organizations all around the country and in some cases outside of the country. And so Rod's a huge asset. He works with our team because we have the same purpose. We're aligned. He wants to help you guys as well. So if you get a message from Nano, if you get a message from Rod, their number one full intention is to help you, answer your questions, help you make faster progress, get you more information, whatever that might be. So be sure to reach out to them or answer their text if you get one. The other thing I want to just really quickly go over is if you're watching this and you're not a client yet, okay? If you're not a client yet, I want to encourage you to grab a copy of my book, okay? This is my book, Blueprint to Financial Freedom. Okay, this is completely free. You go to jerryfetta.com/B2F promo, right? And you can get a free copy of the book. You cover your shipping. Now, here's what's different about my book is it's simple, it's true, and it's applicable. Like you can read it and go do the stuff in it tomorrow, okay? The other thing is we actually give you a course supervisor, meaning we have someone on salary, on staff, making sure you read the book and that you get through it and they answer your questions as you go. The next thing is that we will help you implement. And as you're going through it, if you're like, this makes sense, I want to do the things that the book says, I want to make this kind of progress in my life, my team's going to help you with that. Every single book comes with a free coaching call with Nano or with Rod. Okay. So grab the book again. That's jerryfetta.com/B2F promo. You can get that for free. Right now, without further ado, let's jump into the material. Let me get a sip of my coffee here. Okay. So okay, Kevin says incredible book on page 45 and blown away. That's awesome, Kevin. I'm glad that Kevin is having such a win with that. I had someone on YouTube today that was like, I can't put your book down. Like they're addicted to it, which is like, that's super cool. That's as an author, I love hearing that. So I want to talk about the sacred account. First off, what is the sacred account? The sacred account, and this is my philosophy. It's not so much what it is, it's what it does. Right. So I'll tell you what it is, but I want to explain to you first what it does. And I'm going to do that through drawing really terrible looking pictures. Okay. Because that's the best way for me to explain things. Right. So you have money that you save. We have this thing called the triangle of wealth. Okay. The triangle of wealth. And the triangle of wealth looks like this, guys. There's three simple things that we all need to do. We all need to earn. We all need to save. And we all need to invest. That's it. Like if you did just these things, you would be totally fine. You would build wealth automatically. Okay. Now, with this whole triangle of wealth, earning is the powerful one. Okay. Like this is the one, if I increase my income, I increase my saving, I increase my investing. Right. So I tell people earning is the gas pedal. The more income I can earn, you know, I can save more, I can invest more, I can do so many other things. Earning is like the number one thing I need to be able to do. Now, earning, contrary to popular belief, doesn't come from corporations or the government or some magical fairy tale of opportunity that only some people have. Earning comes through adding value to others and getting an exchange with them. Doesn't matter. And like none of the other stuff matters, right? So yesterday, as an example, my car had a flat tire. Right. And I needed to get it fixed. And I called the dealership and I was like, hey, I need a flat tire. And the dealership was not of value to me. Okay. I called them and they were like, oh, you need a new tire. You need a new wheel. You need a new sensor. The whole thing's shot. It's going to cost you $800 plus taxes and towing. So basically they wanted $1,000 to fix my right front tire. Okay. I will tell you, the dealership did not earn income yesterday. I didn't go to them. I called someone else. Right. Now, the guy I called was this Mexican dude, has a shop down the road. I sent him a picture. He's like, yeah, you don't like, I can fix this in 20 minutes. It'll cost you like $50. Okay. He had the opportunity there and he took advantage of it. The dealership didn't. And here's why I point that out. The dealership, this giant established multi-million-dollar corporation, blew an $800 sale because they weren't thinking about adding value. They weren't thinking about, this person needs help. How do I help them? How do I get an exchange with them? Instead, they were thinking about, how do we get as much money out of this guy? Even if it means being dishonest, that's not earning, that's theft, right? Like if I would have done business with them, not knowing there was another alternative, and I found out later, I wouldn't have been like feeling good about it, right? So I go to this Mexican guy's shop. I don't care that he's Mexican. I don't care that it's not the dealership. I don't care about anything. He can help me. He can help me. I have money. I have a problem. He has a solution. And so I solved the problem with them. And so he earned income yesterday, right? Now, when you earn income, you need to then be able to save it, right? Traditionally, where do we save? Think about, where do we save? If we save anything at all, we usually give money to 2 people, actually 3 people. One of them is unintentional. Before anybody else, the first person that gets our money is the IRS, income tax, right? Now, this is ironic, but for some people, this is their form of saving. They get something at the beginning of each year in springtime called a tax refund. And if they didn't get a tax refund, they would have no savings. right? A tax refund means that I gave the IRS too much of my money all year long. I charged them 0 interest. They paid me nothing to hold it. And at the end of the year, they give it back to me and say, oh, sorry, we took too much. Here's your refund. And they expect me to celebrate. Okay. So that's the first way that most people actually save, is through a tax refund, which is unintentional. Like, this is literally like the lowest form of responsibility when it comes to saving possible, is the tax refund. The next one, what do we do next? We usually put it in a 401k plan. Comes right out of our paycheck before we even get paid. Where does it go? That goes to Wall Street, right? The IRS and Wall Street are in business together, right? Literally, Wall Street, they commit fraud, and the penalties for committing fraud, in a bookkeeping sense, they build it as a cost of goods sold. Like, they're like, okay, we're going to pay, $100 million in fines. As long as we can make more than that committing fraud, we're going to do it. Right. So we give our money to Wall Street. We now not only like, and I don't want to ride the fraud thing, like that's whatever, right? But I can't touch that till I'm 60. I've got no control over it. The guy that I was talking to yesterday, he's like, dude, I lost 20 grand last week in my retirement account. Right? Like, he's got the ups and downs happening. There's not control there. I learned this the hard way. You have to have control over your assets. You can't have assets that aren't backed by something. You've got to have real things, real value backed behind the assets. So when I give money to Wall Street, that's not the case. Okay. The third group most people save with is the bank. Right? Now, this is more like an afterthought. Most people who save in the bank, they save their leftovers, meaning they earn their income, they pay their taxes, they put the money in the 401k, they spend everything, and then whatever's left, they leave in a checking account or a savings account. And in a bank, what are they making? They're making 0.01% per year in interest. If you made more than $10 on that interest, you're going to pay taxes on that piddly little number, right? And while you put it there, the bank, they're investing it. Okay, they're loaning it out. They're putting it into markets. They're trading foreign currencies and stocks and all sorts of things. The number one buyer and owner of whole life insurance, which is what we're going to talk about today, is banks. Bank of America has over $22 billion in life insurance cash value. The largest banks in the US, when you take their balance sheets and you look at them as a total, there's over $200 billion in the whole life insurance cash value. For Bank of America, they own more life insurance cash value than they own real estate. Think about this. Like, this is a serious, like, that's a big statement. Why are they doing this? And you have to look at this. We're going to dive into today, like the reasons why and what they're using it for and how we can do similar strategies. But with saving, here's the number one thing, is cut out the middleman, right? Get rid of the middleman. The middleman, who is the middleman? The middleman is the IRS taking your paycheck and giving it back to you at the end of the year. Get rid of that. Okay, don't get a tax refund. I would rather owe and have to pay them and have kept my money all year long and made money with it so I could afford to pay them, right? Or break even where I don't owe them anything and they don't give me anything back. Okay, who's another middleman? Wall Street. Okay, I give money to Wall Street in my 401k. They're going to invest it on my behalf when I'm 60. What if I cut them out and just invest in myself? What if I do something like a self-directed IRA or a self-directed 401k? Right? What's another middleman? The bank. Like, why would I loan my money to the bank for 0.01% a year so that they can go make double and triple digits on it and pay me this tiny little return? I could cut them out. I could go buy the life insurance myself. I could go do the real estate investing and lending myself. All the stuff they can do, I can do myself. Why even do it with them? Right? Now, here's the thing is, it's not just what you earn, it's what you keep. So that's saving. It's not just what you keep, it's where you keep it. Where am I saving my money? Okay, am I saving my money somewhere where it's going to be there when I need it? That's the first question I ask. Is it going to be there when I need it? I use the illustration of, when I'm storing something, let's say I park my car in the garage, I'm storing it there overnight. Like, my number one expectation of parking my car in a garage is that tomorrow there will be a car. Like, the car that I put there, right, is going to be there when I come to get it out tomorrow. Not that I grew an extra car, not that there was no taxes on my car. Like that's all great if that can happen. But the number one thing is that there is a car there. I put one in last night. I can pull it out tomorrow and go to work. Right? Same thing with saving. When I save money, where I'm saving it, I need to be able to know for sure it's there. And I need to be able to access it. Right? So for me, the tax return automatically not a thing. I can't access it. I don't know it's there. Right? The 401k, Wall Street, not a thing for me. I can't access it. I don't know that it's there. The bank, I can access it. Like, I could pull it out, but here's the thing. It's not there. I know for a fact it's not there. Most people save in a bank because they think it's going to be safe and they've got the money there and they can access it whenever they want. There's a thing that I talked about last week. I've covered this before. It's called fractional reserve banking. Okay, fractional reserve banking means that when I put money in my bank account, with it doesn't matter, any bank, they only have to keep a percentage of it on hand and they're going to invest the rest of my money. Okay, up until 2020, that ratio was about 10%. They had to keep about 10% of my deposits on hand, and then they could loan out the rest. They could invest the rest. They could literally gamble with it in the markets, right? So they're literally telling me, like, this is part of the rules of banking. They're saying, Jerry, you parked your car in the garage, only the tire is there. The other 90% of your vehicle, we're using it, and we're not going to pay you very much for it. We could lose it, right? In 2020, this got cut to zero. They're telling me, Jerry, your car is not in the garage. You parked it in the garage. You intend to use it tomorrow. We understand this. We think we'll have it back. If we don't, there's insurance. Don't worry about it. By the way, you pay the insurance through your taxes. We don't need to get into that detail, but I know for a fact my money's not there, right? Like, at least with Wall Street, it's like, okay, I own some shares of something. I don't know what that means or what they're going to do, but at least I know that's there, right? With IRS, it's like, okay, at least I know I'm going to get a tax refund. With the bank, they're disclosing none of your money's here. You gave it to us. None of it's here. We don't have it. We invested it. We might lose it. It's insured. You pay the insurance through your taxes, so don't worry about it. You'll pay the bill either way, right? So I don't save with the bank. We go back to the triangle of wealth. It's not just what you keep. It's where you keep it. And so I keep it in the sacred account. Okay. The sacred account is whole life insurance. It's I'm going to give you the abbreviation here. It's high early cash value, HECV. It's dividend paying whole life insurance. High early cash value, dividend paying whole life insurance. We call it the sacred account because that's a very long name to be like, oh, where do you put your money? I put it in high early cash value, dividend paying whole life insurance. Even if you turn that into an acronym, I put it in HECV, DV, or DPWLI. Like, no one's going to understand that. So we just call it the sacred account. The reason we call it the sacred account is this is only used for three things, actually four things. Number one is paying off consumer debt. Number two is building reserves. Number three is making large purchases. Number four is investing for passive income. It is sacred. We only use it for those four things. We do not use it for anything else, right? This is not an emergency fund. This is not a retirement account. We're not going to gamble with this money. We're not speculating. We're not buying Bitcoin. We're doing just those four things, right? Now, I said this is a long name. And what I meant by that is this is actually a very specific name, right? That's why it's long. It's how specific this is. There is one kind of life insurance. It's high early cash value, dividend paying whole life insurance. I don't buy, do, or sell any of the other kinds, right? So it's kind of like saying I drive a Chevy, right? Like, okay, I own life insurance. Now, I could say I drive a 2023 blue Chevy Cobalt with, this trim level and this, then I have all the, this interior, and it's going to be a really long name, but that's because of how specific it is. I drive that specific car, that specific color, that specific trim level, that specific interior. And that's why there's all these words there, because we're saying how specific it really is, right? So when I'm looking at this life insurance, that's what I'm saying is, okay, this is a very specific kind. It's not even that the name is long, because I could just say, oh, I own whole life insurance. Oh, I drive a Chevy, right? But I'm telling you, no, this is that specific where we have all of this listed so that we can get the details of, okay, what kind is it? And then we just call it the sacred account. Now, I want to share with you the way that the wealthy use life insurance. And really quick, I do want to check our chat. Again, if you don't have a sacred account, reach out to Nano, reach out to Rod. If you want to get the book, grab the book as well. You can go to jerryfetta.com/B2F. Let me just see if we have any questions here in the chat before we dive into how the wealthy use this. So we have a question from Michael Prey on Mint Builder. Let me bring Michael on really quick. So I do answer the questions live so I can chat with people. It's one of the times I get to connect and actually talk. So we're live with Michael. How are you doing today, Michael?
Hey, Jerry, doing great. Thanks much. How are you doing?
I'm doing good. Thanks for asking. So you have a question on Mint Builder. How can I help out?
I do. So I started your program and in the process of shifting to the sacred account, and I know I've gotten an order from Mint Builder, but I was hoping you could explain a little bit more about what their emails are, what they're doing, and how that fits into your program.
Totally. So Mint Builder, they serve a very specific function with us, and so I'm gonna sketch this out for Michael and for other clients. So there are basically three places we like to put money. We like to put money in life insurance. We like to put money in gold and silver. And we like to do real estate. These are the big three, right? Now, we don't just do these three things. We do them the way that the banks and large institutions do it. So with life insurance, if you were to actually Google bank-owned life insurance, BOLI, or corporate-owned life insurance, COLI, there's a very specific way this is designed. That's the high early cash value dividend paying whole life insurance model, right? So we do the life insurance that specific way because that's what the actual banks do, right? Like we were told you can save in a bank. We were told you could rob a bank. No one ever told us we could be a bank. So when I learned I could be a bank, I was like, okay, let me just figure out what they do, and I'm going to do it that way. So we look at the old adage. I don't even know what movie this is from. I think it's a chick flick. The whole never pay retail thing. Never pay retail, right? So if you're going to buy life insurance, do it wholesale. Do it like a bank does. Design it the way banks do. That's what the sacred account is. Same with gold and silver. So with Mint Builder, there's two things that this does. Number one, it's a forced savings plan with gold and silver, right? Only 12% of Americans own any gold and silver at all, like at all, period, whether jewelry or whether it's not, right? So only 12% of Americans own any at all. The central bank owns $500 billion worth of gold. The United States Central Bank does. That's $500 billion in gold, and that's 80% of their reserves. So we have like the largest, most powerful financial institution, which is actually a private corporation in the entire world, and 80% of their reserves are in gold and silver, right? There's only enough gold in existence for everyone in the entire planet to own 1 ounce. There's only enough silver in existence for everyone on the entire planet to own 8 ounces, right? So the thing with gold and silver, it's a real store of value. It's historically proven. It's got a 6,000-year track record. It's a great place to save. It's not an investment. We're not speculating. We're not buying at this price, selling at that price. So we want to be on a forced savings plan. And so this allows us to do that. So with Mint Builder, when you have a membership, you can add auto ship assets and you can have those show up at your door every single month. So that puts you on a forced savings plan, an automated savings plan. So it's forced savings. Okay. The other thing that it does is it gives you wholesale access, right? So part of your monthly membership is the actual gold itself. Part of it is your wholesale access. Okay, what this means is you can log in on your Mint Builder membership and you can buy gold and silver the same way that a bank would. Like you're not paying retail, you're buying wholesale cost, right? So you're saving, that might be, 2, 3, 4% on your purchases. There's no fees when you sell. The storage is free, right? You're not having, your personal information being sold. Your trade orders aren't being sold to hedge funds like a lot of the other big box retailers will do. So this gives you wholesale access. So when I buy gold and silver myself, I only buy wholesale. I don't go to jmbullion.com. I don't go to the local pawn shop. I go to my wholesale membership and I buy it there. And so I'm paying, without all of the extra markups. I'm not paying all these extra costs. So that's what Mint Builder does. So it's a forced savings plan, and then it's also a wholesale membership. And so I've known Matt and I've worked with them since 2015, I want to say. And so they're, a close partner of ours. They help a lot of our clients out. Good question on that. Let me see what other questions we have. Lauren says, Rodrigo and Nano are amazing. I agree. Caleb just talked to Nano today. Rod says, no, I am not the Mexican he is referring to that fixed his car. That's hilarious. Rod says, we now have an amazing tax agency in addition to Tax Hive. We have a service called a tax what if we're using for clients. If you want to learn more about that, reach out to Rod. Yeah. So with the tax thing, like we have a company we work with called Tax Hive. They're partnered with Kevin O'Leary. We also have our own internal tax agency. And so we're able to do tax planning there as well. So that's a way we can help people, not have to pay extra money to the IRS. Good. Let me see if we have any questions on Facebook. Okay, good. No questions so far. So I want to jump into then, how do the wealthy use... Okay, Jamie has a question. Is there a cost for Mint Builder to hold your gold and silver? So if you hold your gold and silver with Mint Builder, there's two memberships. There's the Pro membership and the basic membership. If you're a Pro member, storage literally costs you $0. It's free, right? Which is insane. Like if you go, I've seen, retail storage for gold and silver charging 1.5%. 1% a year is pretty normal. If you're a basic member, I think you might pay 0.50% a year, like 0.3 or 0.50, something like that. Is very cheap as well. And again, like that's unheard of in the industry. Like if the average is 1%, you're paying, a third, or you're paying half for storage. So that's the holding costs there. I would recommend, if you're buying a lot or you want to buy a lot, get the Pro membership, because then your storage is free and you're getting even cheaper prices. And then your selling is also free. For those of you that don't know, gold and silver dealers, it works like the car industry. Who's ever sold a car back to the dealer? You always get hosed, right? Like you pay a little bit on the front end for sure, but where you really get punished is when you trade in a vehicle and they're like, oh no, regardless of what the blue book value says, here's what we're willing to pay. And then they kill you, right? So the bullion industry, the gold and silver industry, they do the same thing, right? Like they're going to say, okay, we'll sell it to you really cheap. The reason it's really cheap is because they're selling your personal information to marketing companies, and the trades, the purchases you make, they sell that to hedge funds so that hedge funds can bet against you and make money at your loss, right? Like you're fueling your own demise when you buy from some of these big box retailers online, right? But the other thing they do is they charge a sellback fee. So you go to them and you're like, hey, I want to sell. And they're like, okay, great. We're going to charge you to sell. Right? So they're going to make usually more money on the sale, because when you sell, you're not usually selling because the price went down. You're usually selling because the price went up. So you're paying a percentage of a higher number, which equals more dollars in fees. Plus, then you pay them for storage, right? Jamie asks, is there an advantage of them holding it versus taking physical delivery? That's a good question, Jamie. So if you're not buying a ton, it's fine to keep it at home or on your person. I would never store it in a bank vault, right? Like that's a terrible idea. But if you have a safe at home, or you've got like a diversion safe or somewhere you can hide it, and it's a smaller amount, that's okay. Where you start getting into like the amount where you have attention on like, should I be insuring this? That's usually where it's like, okay, I'm going to send it to a vault. The other thing is, if you're going to borrow against it, if you're going to lease it out, something of that nature, generally it's going to have to be in a vault as well. So that's kind of when you would store yourself versus when you would store in the vault with them. All right, so our little gold and silver tangent, which I don't mind. I love gold and silver. Let me talk about what the corporations are actually using this life insurance for. Okay. Now, the first thing is the death benefit. This is life insurance. It does have a death benefit. So if I'm a CEO or I'm a shareholder of a bank, let's say Bank of America, JP Morgan Chase, doesn't matter. My intention is the bank's going to outlive me. It's going to outlive the staff, right? So JP Morgan, he's a banker, like the bank JP Morgan Chase, they merged with Chase Manhattan. It used to just be JP Morgan. JP Morgan was a banker from the 1800s. Okay. AT&T exists because JP Morgan financed it. Bell Telephone Corporation. General Electric exists because JP Morgan financed it. Right? Thomas Edison, the light bulb, JP Morgan financed that. His bank has been around for hundreds of years, the mid 1800s, right? His dad was a banker before that. His name was also, I think, JP Morgan. So I think there was JP Morgan Jr. and Senior. His dad was a banker before that. They were direct partners with the Rothschilds family, right? So you look at, okay, way back, this is like the 1700s, the 1800s. That's how long his bank has been in existence. It's still the #1 bank in the country today. Okay, so the executive, if I'm Jamie Dimon, CEO of JP Morgan Chase, I know in 100 years, my company is going to be here and I won't be. right? I need to make sure that I perpetuate and I expand that business. Now, what does that look like for me as a person? If I have a family, I know that my family is going to be here in 100 years and I won't be. What's the financial condition they're going to be in, right? So what banks will do is they will buy a sacred account. For them, they call it BOLI, bank-owned life insurance. They have a death benefit and they're going to insure a key employee. Okay, somebody that's an executive in the bank is going to be the one that the death benefit covers, so that when this key employee dies, that death benefit pays out to the bank tax-free. Right? Now, what does that mean? That means that, you know, for the 15, 20, 30, 40 years that this key employee works at the bank's doing what? They're paying them a salary, they're paying them bonuses, right? So when this person passes away, this key employee is no longer around, they've lost an asset. Right? People in a business, people are the number one asset. The staff are the asset in the business. That's the biggest and most important part. And so the bank loses their asset. So they have, you know, let's say Jamie Dimon passes away. Brilliant guy, excellent banker. They just lost the number one asset. And so he's gone. The bank is actually at a financial loss. Okay. So that death benefit will pay out to the bank, and they're basically going to get financially compensated to replace that person. And a lot of times they're going to look at the salaries and the bonuses and everything they paid, and that's going to kind of be like a refund from that death benefit. The bank's going to have a boomerang. They're going to get paid back. Okay. Very similar concept that the Rockefellers did. Rockefeller Family Trust, when you're an heir or a beneficiary of that trust, before you're allowed to take distributions, you must get a whole life insurance policy and name the trust as the beneficiary. Why? Because Rockefeller wanted generational wealth. So he said, if you're going to pull money out, when you die, you're going to make sure you pay the trust back. That death benefit will pay back the trust, just like this will pay back the bank, right? So this is the first thing we look at. We want to mimic this part. This is how we secure generational wealth, right? So for me, like, let's say, for example, if I have, let's say I'm married, I have kids, I have all this going on. Okay, I'm the breadwinner, I'm the income earner, right? So I have a death benefit covering me. Okay, that death benefit, I am the key person, right? It's covering me as the key person. Because if I die, my family will lose financially. My income's not there. My production is not there anymore, right? So this key person, me in this case, let's say I pass away, this death benefit pays out to the family trust, right? And it basically gives them a reimbursement on you know, all of the income they're going to lose because I'm no longer there. Okay, let's flip this around. Let's say that I'm a homemaker and I have a spouse that they're the producer, they're the key person in the household economically. Then I need to cover them, right? It's like I'm the CEO, that's the person producing. I need to make sure that the death benefit covers them so that it pays out into the family trust, right? So for me, like when I think of the game of wealth, I already know I want to build wealth. I already know I want financial freedom. I already know that I want to leave money behind for my family, my church, my charities, all these things that matter to me. The number one way to do that is to cheat. Okay. And here's what I mean by that. What better way than to secure a death benefit that's going to pay out if I die, so that if for some reason I don't make my target, it happens anyways. Right? Like I'm insuring against the odds that I don't build financial independence that's going to be generational. That's the first thing banks do. Okay. So that's the importance of the death benefit. So this is why, guys, that we don't do term insurance. Term insurance, it covers me for 20 years. Okay. Whole life insurance covers me till age 121. And if I still am living at age 121, they're going to pay the death benefit out to me anyways, even while I'm still alive. Right? Universal life insurance, it goes up in cost every year. It's got to be reduced or canceled. Nothing else works for this, only whole life insurance. This is why this is what banks use. Okay. So that's the first part, is the death benefit. The second part is reserves. Okay. So the life insurance has a cash value. So when I put in, let's say I put in $1,000 and I put this into my sacred account. SA for sacred account. I put this into my sacred account. Of this 1,000, 70 to 90% of it from day one is immediately available in something called my cash value. My cash value is the savings component attached to the life insurance policy. So if I put in $1,000, from day one, I can borrow 70 to 90% of it. Now, this $1,000, it's going to grow at about 3 to 5% per year, tax-free. So it's going to grow. Not only is it going to grow, it's guaranteed against loss. And it not only is it guaranteed against loss, since the mid 1800s, like 160, 170 years, it has never lost money and only ever made money. So it's cool to guarantee something. It's even cooler to be like the person that guaranteed it has actually kept that guarantee for 170 years in a row. And I specify the phrase in a row because it wasn't like 170 years and a few times like the Great Depression. They didn't. No. The Great Depression, they didn't lose money. They still paid a dividend. They still had this growth. COVID happened. They didn't lose money. They still paid out. The tech bubble happened. They didn't lose money. They still paid out. The mortgage crisis happened. Not only did they not lose money and they still paid out, they didn't need bailouts. They were completely fine. Right? So this $1,000, it's guaranteed against loss. It's guaranteed to grow. It's also protected from taxes. It cannot be taxed. Okay. It cannot be taken by creditors. It cannot be taken in a lawsuit. It's got privacy. It's a private agreement between me and the insurance company. It's literally the safest place that I could put my money. This is why the banks put their money there. Okay, they put 20% of it's called tier 1 capital. Tier 1 capital means it's like their most safe prize reserves. We might call that an emergency fund. It's the money that no matter what, they want that cushion there. There are only usually about 3 things that a bank will consider tier 1 capital: gold, US treasuries, and life insurance. So about 20% of it goes into life insurance. Right? This is why I'm saying this is different than what we've heard about. This is not the stuff that you Google or you hear Dave Ramsey or the guy that's in that insurance multi-level marketing thing telling you about. No. This is literally what the banks are using. And they're putting 20% of their tier 1 reserves in it. And they consider it just like as good as gold, and ironically as good as the US Treasury, which I don't consider as good, but I understand where they're coming from. So it's going to grow at 3 to 5%. This $1,000 will. Check this out. While it's growing at 3 to 5%, I can borrow 70 to 90% of it. And my cost to borrow is only going to be about 1 to 3% if I structure this correctly. Because I'm borrowing, I can't get taxed. A loan is not taxable. And because I'm borrowing, this $1,000 never left. It's still earning 3 to 5%. So let me ask you this: 3 to 5%, this averages out, let's say 4%. My cost to borrow, 1 to 3%. Let's say this averages out as a 2% cost. What's 4 minus 2? Positive 2%. So when I'm borrowing my own money, I am making 2% to borrow my own money. This is better than a 0% loan. A 0% loan, they don't pay me. It's just zero. This is better than a cheap interest rate. A cheap interest rate, they're still charging me. No. Here, I am making 2% to borrow my own money. That's ridiculous. Right? So this is another thing banks will do is they structure it with high early cash value. They'll use it for reserves. They're able to borrow against it. These dividends, they could take these tax-free and use this to fund different things within the bank. So that's a big part of what they do. Right? So I want to mimic that as well. So I have a significant amount of reserves in my life insurance cash value. Okay, and I continue putting money into that. I want to build that up and I want to become my own bank. Okay. Now, the other thing that this allows us to do, there's this thing I talk about. It's called the Banking Quadrant. Okay, the Banking Quadrants. Okay, so with a bank, there's usually 4 parties. There are depositors. There are borrowers. There are bankers. And there are also shareholders. Right? So, and really quickly, guys, I do need to make sure we check in with questions before I jump into the banking quadrant. I do want to check any questions that are in the chat. Again, if you have not reached out to Nano and Rod, if they sent you a message, be sure that you connect with them. Kevin says that even financed the U.S. government for World War I. Yeah, J.P. Morgan financed a lot of stuff. They have affiliates that finance Germany as well. So they financed both sides of the war, which is kind of what these larger banks do. So again, if you guys have not connected with Nano, if you've not connected with Rod, reach out in the chat. And then once again, if you do not have a copy of my book yet, okay, do that now. Go to the website. This is going to be jerryfetta.com/B2F promo. Okay, you can get a copy of my book. That's free. Again, you cover the shipping. You get a free coaching call, free course supervisor will help you implement the material that's in the book. and actually win with it with your own finances. So go to the page, reach out to Nano, reach out to Rod, get on your coaching call, get that schedule, get the book. Okay. Let me see if we have any other questions or things in the chat here. Okay, I don't see any new questions so far. So I want to just check Facebook and then we'll continue on with the banking quadrant. All right, so the banking quadrant looks like this, guys. We have depositors, we have borrowers, we have bankers, we have shareholders. Most everyone is a depositor. You're going to put money in a bank, right? Now, some people can borrow. They can go get loans from the bank. Hardly anyone is a banker. Like, count on your hands how many bankers in your life that you actually know personally. And then even fewer are shareholders in banks, right? So we've got these different quadrants, and the bank gets to be all four of them, right? The bankers usually are shareholders. They earn dividends on their bank. Okay, obviously they're the banker. The bank gets to borrow funds. The bank gets to deposit money. They get to do all of these things. So by using the sacred account, we get to do all four of these things as well. I deposit money in. Okay, so that's that $1,000 that I put in. Okay, that's growing. There's a guaranteed interest rate. Okay, I also get a dividend. The dividend is what shareholders get. I get profit from the bank. Okay, the bank in this case is the insurance company. When I own a life insurance policy with one of these insurance companies, okay, then when they're profitable, they share that profit with me. Right? So that's where that dividend comes from. I am literally an owner in this company. I have equity in it. They share their profits. One thing that I learned, several years back, because you start working in finances, you realize there's all these giant corporations, and if they wanted to smash you, they could, right? The 2008 housing crisis, perfect example of that. They're like, hey, let's scam everybody and make a bunch of money. And they did, right? Because there's no recourse. Nothing happens. They pay a fine. That's it, right? Like, okay, they can afford the fine. It wasn't that bad. With these insurance companies, if they make me a partner, we're now in alignment. What they do to me, they do to themselves now. See what I mean? It's not like they have my money and they're going to charge me fees and there's no connection, there's no recourse. No. I'm an equity shareholder in their company. If they screw me over, they have to do it to themselves first. I like that. Like, that puts me in a position where we're of the same interest, we're aligned. And so whatever you do to you, you do to me. Whatever you do to me, you do to you. And so they're not going to do stuff to me that they wouldn't want to experience themselves because we're partners. Right? So I like that with the life insurance companies. As a partner, I earn a dividend. So I get a guaranteed rate on my cash value. I get a dividend. I can also, as a banker, borrow against my deposits. Right? So when I put money in, I can take a loan against my deposits. There's going to be an interest rate that I pay, just like a bank pays to a depositor. And then I also get to be the borrower. I can then use this for an asset. I can buy real estate, for example. And I can lend this out. I can lend this out to others. And I can make 8 to 12% doing that. Right? So if I'm making 3 to 5 over here with my bank on just taking loans against my policy, right? And then I have 8 to 12 over here. Like, for me, this is a very stable return. This life insurance policy is going to pay me this rate. I know that. There's no question about it. It's done it for 170 years. Okay. The real estate, that's also going to pay me this return. I know that because I do seller finance, I do private lending, and there's an asset behind it. This is not like I have it in the stock market and it's going up and down and I hope the average is 8 to 12. It's no. This person contractually has to pay me 12% to take away their house. Okay. The life insurance company contractually has to pay me 3 to 5. It's going to happen. And if it doesn't, I can do something about it. You see? So this allows me to be like a bank, to be like the wealthy in how I operate. Who heard last year Elon Musk had that tax problem where he borrowed against his stock? And there was that big thing where they're like, oh, he doesn't pay enough taxes. He borrowed against all this Tesla stock tax-free. That's how the wealthy do it. When you have an asset, you don't sell the asset if it's a good asset. If Elon sells his Tesla stock, everyone sells, and then Tesla goes bankrupt because they have no earnings. If you take away their government subsidy income, they're not a profitable company anymore. Right? So Elon can't sell, doesn't want to sell. That's his bread and butter. That's his baby. He's going to keep that stock, but he can take loans against it. And when he takes loans against it, it doesn't matter if it increased 5 times in value. he doesn't have to pay taxes because it's a loan, and a loan is not taxable. Okay, I talked about last week, Apple, they have their headquarters in Ireland. Okay, the reason why is Ireland is a tax haven. When they want to move money to the US, instead of selling or moving money to the US that can be taxed, they take loans from their Ireland corporation to fund the US stuff so they don't have to pay taxes because the government cannot tax a loan. It's not income. It's not a gain. It's a loan. It's no different than you have a credit card. They can't tax you for getting a credit card. It's a loan. If you have a house and you borrow against your house, they can't tax you for borrowing against your house. It's a loan. Right? So with this being said, and we're kind of coming to a close here, as we're using life insurance, we're using it the way the wealthy use it. Right? Like everything that we do it the way that the wealthy do it historically. That's what my book is about. The book is not my own stuff. I didn't come up with it. I studied the top 1% for over a decade and looked at this is what they do. These are the trends. These are the commonalities. We can all do these things, right? The life insurance, we do it the way that the wealthy do it. The gold and silver, we buy it through mint builder wholesaler because the wealthy people use wholesale. They don't buy retail. Even the real estate, we do it the way the banks do it. The banks don't own a bunch of rental properties. They do seller finance, they do private lending, they do it all around the country, and they collect interest on single family homes like in the thousands and thousands. Right? So we do the same thing with taxes. We do the same way as the wealthy do. We don't go to TurboTax or have my cousin do it or my sister-in-law who will do it for free. No. We actually do a real proactive tax plan at the end of the year before December 15th. We get it done, we get it executed, and then we save on taxes. That's the way that the wealthy do it. Right? So part of it is, we have this thing, and I'm going to wrap up on this note and then answer some more questions. There's this thing called be, do, have. Okay, this is the way to create anything you want to create in your life, right? Be, do, have. So let's say that I want to be financially independent. That's B. Okay. Now, why do I want to be financially independent? Well, it's because of the things I'm going to have, right? Ultimately, I want to be something usually because of what I'll have. I want to be a dad because I'll have kids. I want to be married because I'll have a wife. I want to be in shape because I'll have better health, right? I want to be financially independent because I'll have freedom, or I'll have the ability to travel, or have the ability to stop working the job that I hate, right? So generally speaking, we actually look at what we want to have and we identify who else has it. And then we're like, well, I want to be that, right? So when we look at, I want to have financial independence, I want to have wealth, and we look around at who else has it. The banks have it. Wall Street has it. Governments have it. Like more than anybody else, those groups have it. These gigantic corporations, they have it. Can I find individuals in my area that have it? Sure. I can find the guy that does the real estate investing in my community and he's got some wealth, but not to that extent, right? So when I look at this, I look at like, who's the best at it? If I want to be, if I'm like looking at basketball and I'm like, I want to have the best basketball skills, I'm going to probably go study Michael Jordan or Kobe Bryant, right? I'm not going to be like, who's the mediocre basketball player at my rec league? Like, I'm going to go start watching Michael Jordan stuff and be like, okay, because even if I don't get as good as him, I'm going to get better than I would have studying someone smaller. See, with the banks, even if I don't get to the size of an actual bank and I'm not JP Morgan Chase, it's fine. I'm going to be better off because I practice the same things that the best in the world practice, right? So I see who else has it and like, oh, I want to be that person. I want to be like that. I want to be that beingness or that group or whoever it might be, right? So I look at what I want to have. What we often miss, what do we need to do? Okay. Right? What do we need to do to get there? So if I want to have something and I want to be something, the thing in the middle that brings these two together is what am I going to do to make it happen? Right? And this is not complicated stuff. This is in the book. I'm going to earn more. Okay. I'm going to spend daily time learning about finances. I'm going to save more. I'm going to invest in real assets. Like think about the dude, like that's going to be now effort and energy and time that I'm going to invest in order to have these things that I say I want to have. As the question comes down to it, do I really want to have these things? Okay, and if I do, then I need to do what it takes. And I need to understand it's going to take time. It's going to take money. It's going to take learning. Like, do I really think I'm going to build financial independence and spend no time studying finances? Think about that. Like, do I really think that I'm going to do that? And it's going to take me zero time. And it's going to take me zero money invested and zero studying. Like, name one thing where that's the case. Even if I want to be broke, that takes time. I'm going to invest time in doing things that make me broke. Like nothing is free. Everything is like, I've got to put something into it to get something out of it. That's the doing side, right? Now, here's the fun part. Here's the being side, right? Being is the persona that I'm going to take on, like the role that I'm going to play, the who am I in this game? And we can all decide to be today. I'm going to be like a bank is. I'm going to be like the wealthy are, even though I'm not there yet. Part of me getting there is me deciding I'm going to be that, even though I'm not there yet. Okay. The person who can do that, they can take on the persona. They can be that part, even though they don't have all the products, so that they can start doing the things to have the end result. That's the person that's going to win. Okay. That's the person that's going to have enthusiasm. That's the person that's going to stick with it. That's the person that's not going to have, a reduction in their purposes and goals. Right? So be, do, have. If I want to have wealth, I need to do what I need to do. And I need to be somebody that's going to get there. Right? So I want to close out on this note. I do want to open up for some questions before we wrap up. One more time, guys, if you do not have a copy of my book yet, okay, grab that. Go to jerryfetta.com/B2F promo. Let me put this back up again. jerryfetta.com/B2F promo. And you saw what Kevin said in the comments. He loves the book. I think this guy on YouTube was Josh, couldn't put it down. Like, this is a great thing for you to be studying. So get the book. It is free. You cover your shipping. You will get a course supervisor. You're going to get a free coaching call. We will help you implement the steps in the book. Again, that's jerryfetta.com/B2F promo. And I'll be really honest with you. If you're not yet a client and you're like, this is awesome, I want to have this stuff. If you're not willing to do 6 hours of studying and do an $8 investment in shipping and handling to get the information you need to have in your hands to have the things you say you want to have, financial independence, wealth, improving your financial security, it's not going to happen, right? It's like me saying, I want to lose weight, but I'm not willing to stop eating, or I'm not willing to start exercising, or I want to improve my relationships, but I'm not willing to, see the best in people and work things out and have, good communication. If I'm not willing to do those things, it's a pipe dream. It will never happen. And it's not going to happen by accident, right? So this is one of those things, if I'm serious about it, I need to be able to get the time invested. I need to be able to put the money into it. I need to put the effort into it and put the study into it. All right, we do have some questions in the chat. Let me see what we have here. All right, so we have a few different questions and comments. So John has a question he addressed to Rod. He said, how can I get started with a sacred account? John, that's an excellent question. So if you're watching this and you're like, hey, I want to get a sacred account, set up a call with Rod or Nano, okay? First things first, they're going to answer all of your questions, right? This is a very informational call. They're going to give you information. They might send you some articles and videos so that you can study up on it more. We don't want you to have a sacred account and be like, oh, they said it was a good idea, but I have no idea how it works and why it works. So you're in the driver's seat. We will help you set it up. We're going to get you started with it, but we want you to be educated. So reach out to Rod, reach out to Nano. Okay, Michael has a question on how do you figure out how much to put into the sacred account? So Michael, my team will help you with that. So Michael Prey was wondering, if I'm interested in setting one up, how do I know how much to put in? So generally speaking, if you have a lump sum of money saved, you can put that in as a start lump sum. And then you'll have either a monthly or an annual contribution. That part is entirely based on your goals and your budget. So my team will work with you on what you feel is the right number. My philosophy is it's a forced savings plan. I want to save more money. Like, I want to do as much as I can, but I also want to think about, okay, in my worst month, what do I know I could commit to still, right? Because I can always put in more, right? So that's what I would say is kind of the idea there. Mark asks, aren't the dividends just a partial return of premiums throughout the year? They are classified like that. But here's the thing. If I put in, let's say over 7 years, I put $100,000 into my life insurance policy, meaning that was my money. And then by year 8, I've got 120,000 in there. What did they return? I've got more money than I put in, right? So you could say when you buy Apple stock, right, and they give a dividend to a shareholder, that the dividend is just a return in an overcharge on Apple iPhones, right? That's just profit. That's how business works. So any time you get a dividend, it is a return of a surplus. The question is, do I have more than I put in, right? So that's the main thing to look at. And with a sacred account set up correctly, definitely you do. Paul, Jerry, I'm reading chapter 5 right now. Can I turn my current mortgage into a line of credit situation? Are there prerequisites to do so? Yes, so there are some prerequisites to that, Paul. So get in touch with Rod or Nano, and they'll basically they'll go through and just find out, you know, what needs to happen for you to be able to do that. And that's another thing you can use. It's similar to how banks use with real estate too. Ziamara says, I need you to text you the email, the video sent. So Rod, get in touch with Ziamara, send those videos if you can. Okay, Kevin says, Jerry, I'm 61, have made the mistake of letting my income drop. I have 5 free and clear properties. Should I look into taking lines of credit on some property to fund my sacred accounts until I get cash flow and income back up? So Kevin, it's hard to say without knowing more data. So what I would do, Kevin, is I would set up a call with Nick and just give them some more information on what you have happening, and they can kind of go through with you on what the best options would be. Generally speaking, I don't like borrowing money to fund a sacred account. So because of the fact that I want to be able to pay that loan back, and the sacred account's not something that I'm usually going to borrow from to fund and then borrow against to repay. But definitely set up a call with Nano and with Rod. All right, Nano has an excellent point. 6 hours of studying to put a solid foundation for finances for life. Most of us will probably put 6 hours into social media, Netflix, and football season over the weekend. Okay, that's true. That's very true. So put the 6 hours on the book instead. Jamie says, would you increase the face amount of your policy or set up another insurance policy if you want to increase the face amount to be able to put in more life insurance? So generally, Jamie, I'll set up another one. And the reason why is when I increase my face amount, usually I'm going to have to restructure. I might have to do a new medical exam. And at that point, it's like I may as well do a new policy so that I don't negatively impact the old one. You're welcome, Kevin. I'm glad to help out with that. Okay, good. So let me see if we have anything on Facebook before we wrap up. Okay, I don't see any comments on Facebook. We have a lot we covered on Zoom. So guys, I'm going to wrap it up here. This has been Sacred Account Saturday. Again, if you do not have the book, okay, go to jerryfetta.com/B2F. Grab a copy of the book. Again, that's going to be jerryfetta.com/B2F promo. Okay, and you can get the book. It's free. You cover your shipping. You get the coaching call. You get the free course supervision. You'll get implementation of the steps in the book. So get the book now. If you're watching and you want to set up a call with Rod or Nano, be sure you reach out to them. We do have a call with Nano Aquino at 4 p.m. Eastern time on Monday. Okay, this is our Monday study call. Nano goes over Liar's Poker again this week. This is a great book. It's behind the scenes with Wall Street, right? Like if you want to know the nitty gritty about Wall Street from the people on Wall Street, go read Liar's Poker. Be on these calls. These are completely free. It's going to be on our Facebook page. It's also on Zoom. So we will send out alerts for that. That's all I've got for you guys today. Have a great weekend. Make sure you grab the book. You do everything you can to study and be in a position to build financial security for your family. And I hope you guys have a great weekend. See you next time.